Imagine waking up tomorrow and gravity suddenly pushes you up instead of pulling you down.
Right. It'd be terrifying.
Exactly. What happens when the fundamental laws you rely on just stop working, like completely invert?
You'd have to rethink your entire reality.
Right. And what if I told you that the financial rules that have governed the world for decades, the literal laws of gravity for global capital, are secretly breaking down right now?
It's a massive shift. We're watching it happen in real time.
Yeah. And whether you're managing a portfolio or, running a business or just trying to understand why the economy feels totally upside down lately, this shift affects you. It affects how global capital moves.
Absolutely, because capital flow dictates the price of literally everything.
Exactly. But the real story is that this massive, silent earthquake in global finance, the collapse of traditional market correlations, it isn't just some temporary glitch.
No, not at all.
Right. It's proof that what we treated as laws of nature in the markets were actually just temporary rules of a very specific regime. And, well, that regime is over. Today's deep dive is all about decoding that new architecture.
And to map out that new architecture, we first have to rigorously define the old map.
The baseline, right.
Yeah, we have to understand the specific mechanical environment we just left behind because, honestly, that is where all the current institutional anchoring bias comes from.
So we're talking about the era of the Great Moderation, basically. The whole binary world of risk on versus risk off.
Yes, and it's critical to understand how deeply embedded that binary became in the actual, the plumbing of finance.
Right.
For decades, investors and central bankers relied on this beautifully symmetrical mental map.
Symmetrical how?
Well, think about a risk-on environment. You've got stable growth, muted inflation, and low volatility.
The Goldilocks zone.
Exactly. In that zone, capital naturally flowed outward on the risk spectrum. Equities rallied, high-yield credit spreads tightened, and emerging market assets boomed.
And safe haven assets, naturally, faced structural headwinds.
Right, because why hold them?
Yeah, there is literally no utility in holding a zero-yielding protective asset when the prevailing macroeconomic winds are giving you steady capital appreciation everywhere else.
Exactly. And the inverse was equally reliable. When a deflationary shock hit or, a credit crisis emerged, we entered the risk-off environment. Right. And the map dictated a mechanical flight to quality. Equity sold off, credit spreads blew out, and capital just surged into defined safe havens.
Like a reflex.
Yeah. Gold would rally as a hedge against systemic uncertainty. The Japanese yen would aggressively strengthen, and the U.S. dollar would absorb global liquidity as the ultimate balancing force.
It was essentially the foundational logic behind the 60/40 portfolio, right? And the whole explosion of risk parity strategies back in the 2010s.
Oh, totally. That was bedrock.
The entire assumption was that when your growth assets take a hit, your defensive assets will inevitably catch a bid because they're negatively correlated.
Right.
It felt automatic.
Like a law of physics?
Yeah. If the market gets scary, you press the buy gold button. If the S&P 500 tanks, you buy treasury futures, you buy yen. It was just hardwired into the algorithms.
What's fascinating here is that the industry collectively forgot why those correlations existed in the first place.
They just took them for granted.
They did. They weren't dictated by financial gravity. They existed because they were rooted in incredibly consistent unidirectional capital flows driven by central bank reaction functions.
Okay, unpack that a bit. The reaction functions.
So for 20 or 30 years, the underlying macro environment remained remarkably uniform. Whenever a crisis hit, the structural response was always identical.
Cut rates?
Exactly. Central banks slash interest rates to zero to stimulate demand, and they could do that because inflation was never the constraint.
Right. We have the so-called Greenspan put, then the Bernanke put, the Powell put.
Exactly. The market knew the central banks would provide a liquidity backstop without having to worry about runaway CPI.
Because inflation was dead anyway.
Right. So the system operated under a specific set of physics where monetary policy was always structurally accommodative during a crisis.
Makes sense.
And when rates are universally slashed to zero, the penalty for holding a non-yielding asset like gold, for instance, completely disappears.
Right, because you aren't missing out on any yield in the bank.
Precisely. Over time, these mechanical, rate-driven reactions became so deeply embedded in trading psychology that managers mistook a descriptive pattern for a predictive guarantee.
Ah, like saying, this is what happens under a deflationary zero interest rate policy regime, and confusing it with, this is what will always happen during any crisis.
Exactly. They confuse a localized weather pattern for the global climate.
Wow. And now, the underlying climate has aggressively shifted, and that old map is just leading people right off a cliff.
Right off a cliff.
Because we are looking at a market right now where the fundamental assets are outright misbehaving. I mean, let's start with the anomaly I mentioned at the top, gold.
The historical anchor of the safe haven trade.
Historically, sure. I mean, if you have geopolitical conflict, sovereign instability, or like a land war, the textbook says you get a gold rush.
That's what the old map says.
Right. But recently, we've seen incredible, terrifying geopolitical escalations. The onset of the war in Ukraine, massive tensions in the Middle East.
Truly historic events.
And yet, during several of those specific escalations, paper gold showed remarkable weakness. If we look at 2022, when the geopolitical risk premium was arguably at its highest in decades, gold spent months trending downward.
It did.
So wait, shouldn't the threat of war make people panic buy gold? Why is the ultimate safe haven failing at its one job?
Well, it failed because traders misunderstood what gold was actually pricing in. The market assumed gold was a pure barometer of geopolitical fear.
And it isn't?
No, gold doesn't trade on sentiment. It trades inversely to real yields.
Okay, let's dig into the mechanics of that. Because looking at nominal yields doesn't really tell the whole story, right? We are talking about the TPS yield, the Treasury inflation-protected securities spread.
That is the critical distinction. A nominal yield is just the headline rate on a bond, like a 5% yield.
Right.
But the real yield is the nominal yield minus the market's expected rate of inflation over that same duration.
Right. So if nominal is 5% and inflation is 3%, your real yield is 2%.
Exactly. It is the actual, true purchasing power you are gaining by holding that sovereign debt. Now think about gold. Gold is a physical commodity.
It yields zero.
It yields absolute zero. It has no cash flow, no dividend, no coupon.
Its only utility is preserving purchasing power.
Correct. So holding gold carries an opportunity cost. If the real yield on a 10-year U.S. Treasury is deeply negative, meaning inflation is running hotter than the interest rate the government is paying you,
then you are guaranteed to lose purchasing power by holding that bond.
yes. And in that environment, the opportunity cost of holding gold is non-existent. You're not missing out on anything. Gold thrives when real yields are negative.
But when central banks, particularly the Federal Reserve, aggressively hike rates to fight sticky inflation.
Which is exactly what we saw recently.
Right, and real yields shoot up to positive 2% or even higher. The math fundamentally changes.
It completely inverts. Even if tanks are rolling across a border and institutional asset managers looking at their mandate and thinking,
do I hold the zero yielding metal, or do I lock in a guaranteed risk-free 2.5% real return above inflation in U.S. Treasuries?
exactly. When real yields rise aggressively, the gravitational pull of that risk-free return completely overrides the historical fear correlation.
The math simply doesn't support allocating capital to a non-yielding asset.
No, it doesn't.
But wait, I have to push back here for a second.
Yeah.
Because this yield argument assumes the market is purely driven by institutional paper traders. What about the massive structural buying we've seen from central banks?
The sovereign accumulation.
Yeah, you have the PBOC in China, the Russian central bank, and various emerging markets buying physical gold at record paces as a de-dollarization strategy. Doesn't that structural sovereign demand override the short-term yield math?
It's an excellent point, and it really highlights the bifurcation in the gold market today. You have to separate the structural, physical floor from the marginal price setter.
Okay, explain the difference.
Central banks accumulating physical bullion for geopolitical de-risking absolutely provides a massive, unprecedented floor under the price of gold.
It sets a baseline.
Right, it prevents a total collapse. But central banks aren't de-trading the GLD ETF.
Right, they aren't staring at screens in New York.
Exactly. The marginal price setter, the flow of capital that dictates the week-to-week or day-to-day price action, is still driven by Western institutional capital, algorithmic trading, and macro hedge funds.
And they are slaves to the yield.
They are legally and fiduciary bound to optimize for yield. So while sovereign buying keeps gold historically elevated, the violent downward swings during crises are mechanically driven by the institutional liquidation of paper gold when real yields spike.
Wow.
The safe haven didn't break. The underlying physics of the marginal capital flow changed.
Now here's where it gets interesting. Because if gold is being bullied by real yields, that exact same yield dynamic is doing something even more violent to the other side of the historical safety trade.
The Japanese yen.
The yen. I mean, in past cycles, fear triggered this massive unwinding, pushing the yen up. We need to go deep on this because you cannot understand global liquidity without understanding how the yen carry trade was built up over the last 20 years.
Absolutely. The yen is perhaps the most fascinating casualty of this entire regime shift because its historical behavior was entirely an artifact of a specific financial structure.
The carry trade.
Yes. The yen carry trade was the defining engine of the yen's old correlation.
How did it start?
To understand it, you have to go back to the bursting of the Japanese asset bubble in the early 1990s.
Right, the lost decades.
Exactly. In response to a massive deflationary spiral, the Bank of Japan implemented zero interest rate policy, or ZIRP, long before the rest of the world even considered it.
They were the pioneers of zero rates.
They were. For decades, the cost of borrowing Japanese yen was essentially zero.
And capital, like water, seeks the path of least resistance to the highest return.
Yeah.
So global macro funds looked at that and realized they could use Japan as a free ATM.
Precisely. They would borrow billions in Japanese yen at roughly 0% interest.
Free money.
Free money. Then they would immediately sell those yen for US dollars, euros, or emerging market currencies and invest that capital into higher yielding assets.
Like U.S. tech equities or Brazilian sovereign debt or mortgage-backed securities.
Right. They captured the spread between the zero-cost liability in Japan and the high-yielding asset abroad.
And because volatility was generally so low during the Great Moderation, they leveraged those trades 10, 20, even 30 to 1.
Yes. Trillions of dollars of synthetic short yen positions were built into the global financial architecture.
Trillions. Just massive leverage.
Exactly. Now, what happens mechanically when a deflationary shock hits? When the VIX spikes and the risk-off panic strikes?
Well, the volatility blows out the risk models of those macro funds. They get margin calls on their high-yielding assets, and they're forced to liquidate.
Exactly. They have to sell their U.S. tech stocks or emerging market bonds, take that cash, and buy back Japanese yen to repay the original loans.
So it's a massive coordinated short squeeze.
Yes. This forced buying of yen to close out short positions is what drove the currency through the roof during every crisis.
That's crazy.
The yen didn't strengthen because investors thought the Japanese economy was a safe bunker.
It strengthened due to the mechanical, violent unwinding of trillions of dollars in leveraged carry trade.
Exactly. It was purely structural.
But that unwind mechanism is completely broken right now. I mean, we've seen massive sell-offs in global equities over the last couple of years. We've seen regional bank failures like SVB.
A classic risk-off trigger.
Exactly. And yet the yen didn't rally. It completely collapsed. Why isn't the carry trade unwinding the way it used to?
Because the divergence in central bank policy became so extreme that it overwhelmed the volatility trigger.
How so?
While the Federal Reserve and the ECB were hiking rates aggressively by 400 or 500 basis points to fight inflation, the Bank of Japan remained trapped in their own monetary experiment.
Yield curve control.
Yield curve control, yes.
YCC, which is basically the policy where a central bank essentially refuses to let the free market price its sovereign debt.
Yes. The Bank of Japan publicly committed to defending a hard cap on the 10-year Japanese government bond yield. Let's say it was 0.25%, and later they bumped it to 0.5%.
Right.
In a global environment where inflation is rising, investors naturally want to sell bonds, which pushes yields up.
It's a fine equilibrium.
Right. But to prevent the yield from breaking their artificial cap, the Bank of Japan had to step in and buy every single bond the market was willing to sell.
And to buy an infinite amount of bonds, you have to print an infinite amount of yen.
Exactly. They essentially sacrificed the currency to defend the bond market peg.
Wow.
So when you have U.S. treasuries yielding 5% and Japanese bonds forcibly pinned near zero by infinite money printing,
the fundamental incentive to hold dollars instead of yen becomes structurally irresistible. The yield differential is simply too wide.
you nailed it. So even when a crisis hits, like SVB, and volatility spikes, institutional investors look at that 500 basis point spread and say, I am not closing my carry trade.
I will endure the volatility because the cost of giving up this massive yield advantage is just too high.
Exactly. The structural weakness imposed by Japan's own balance sheet expansion completely dominated the historical safe haven short squeeze.
The correlation died because the monetary regime diverged.
Perfectly stated.
Which feeds perfectly into the strangest behavior of all. I mean, the yen collapses, the euro struggles under its own regional fragmentation risks, and mechanically the capital flow has to go somewhere.
It has to find a home.
And it all flows into the heavyweight champion of the world, the U.S. dollar.
The asset that has effectively broken the risk-on, risk-off paradigm entirely.
Because under the old map, the dollar was countercyclical. right?
Mm-hmm.
But right now, it isn't balancing anything. It is universally dominant.
It's a juggernaut.
It steamrolls the FX indices, whether equities are rallying to all-time highs or selling off into a correction. How does an asset manage to win in every macro scenario?
It wins because of a concept often referred to as the dollar smile, but it's been amplified by the current rate regime.
The dollar smile. Explain that.
The U.S. dollar has positioned itself at the nexus of multiple reinforcing vectors. Let's look at the left side of the smile, a severe risk-off environment.
So global growth is slowing, credit markets freeze, panic sets in.
Right. In that scenario, the world flocks to the deepest, most liquid, legally secure asset on the planet, the U.S. Treasury market.
Safe haven demand drives the dollar up.
Yes. This is the traditional mechanical response.
But then look at the right side of the smile.
Exactly. The U.S. economy is running hot. GDP is beating expectations. Payrolls are strong. AI is driving a massive equity boom.
In the old world, capital would flow out of the dollar and into emerging markets to seek higher beta returns.
But not today.
Why not?
Because the U.S. economy running hot forced the Federal Reserve to hold rates higher for longer. The U.S. dollar now offers some of the most attractive, risk-free, nominal, and real yields in the developed world.
Right. It has supreme yield superiority over the euro, the yen, and the pound.
So in a risk-on environment, global capital flows into the dollar to capture that premium return while still operating within the safest legal jurisdiction.
So it's a structurally rigged game. If the world is terrified, they buy dollars for liquidity and safety. If the world is greedy and growth is booming, they buy dollars for the yield and U.S. equity outperformance.
It acts as the ultimate destination for capital in both scenarios.
Wow.
It doesn't require a unified narrative to strengthen. It strengthens when fear is the dominant force, and it strengthens when yield is the dominant force. Let's zoom out for a second because we've spent a lot of time diagnosing the symptoms here.
Right. We've looked at gold decoupling from fear, the yen being crushed by yield curve control, and the dollar just becoming omnipresent.
Exactly. But if we really want to understand how to map tomorrow's market, we need to look under the hood.
Right. What is the hidden machinery here? What are the actual fundamental drivers rewiring global capital flows right now?
There are 4 primary drivers that constitute the new physics of the market, and we need to dissect them carefully because this is where the new map is drawn.
Okay, let's go through them. Driver number 1.
Driver number 1, which we've touched on, but we really need to grasp the sheer mathematical gravity of it, is extreme central bank divergence and interest rate differentials.
Basically, the end of the synchronized global monetary cycle.
Yes. Post-2008, global central banks moved as a herd.
Everyone was doing ZRP.
Everyone operated at the zero lower bound. When yields are essentially zero globally, capital is agnostic to borders.
It just wanders around looking for a growth narrative or a momentum trade.
Or a sentiment shift. The FX markets were heavily sentiment-driven back then.
But then the post-COVID inflation shock hit, and the herd violently scattered.
Exactly. The Federal Reserve slammed on the brakes, enacting the steepest rate hiking cycle in modern history.
But other central banks couldn't keep up. They were constrained by their own domestic vulnerabilities.
Right. The ECB was terrified of blowing up Italian sovereign debt, so they lagged. The Bank of Japan was trapped in YCC, like we discussed.
Right.
The PBOC in China was actually cutting rates to manage a massive real estate deflation cycle.
And when you create those massive rate differentials across major sovereign jurisdictions, you fundamentally alter the FX derivatives market.
You do, because capital is ultimately agnostic. It has no loyalty to a flag.
It just wants a return.
It is a relentless force of nature that flows down the yield gradient. When you have a massive differential between the U.S. and China or the U.S. and Europe, capital just avalanches toward the higher yield.
So the foreign exchange market stopped being a mechanism for pricing relative economic growth and simply became a ruthless, mathematically driven rate arbitrage machine.
Beautifully put, yes.
Okay, so that's driver 1. Driver number 2 amplifies that rate dynamic significantly, and it has to do with the actual plumbing of the global economy.
The structural demand for offshore dollar liquidity.
The eurodollar system.
Yeah.
This is arguably the most misunderstood force in macroeconomics.
Oh, without a doubt.
I mean, when people hear eurodollar, they usually think of the exchange rate between the euro and the dollar.
Right. Let's clarify what that actually means.
Yeah, please do.
A eurodollar is simply any U.S. dollar-denominated deposit held in a bank outside of the United States.
And thus outside the direct regulatory purview of the Federal Reserve.
Exactly. And the modern global economy runs entirely on this offshore dollar network.
Give me an example of how that works in practice.
Okay. If a Brazilian corporation buys copper from Chile, The invoice is in dollars. Neither country uses the dollar domestically, but the trade is settled in dollars.
Right.
So to finance that trade, the Brazilian corporation borrows dollars from a bank in London or maybe Singapore. That's a euro-dollar transaction.
And the Bank for International Settlements, the BIS, has estimated there is something like $80 trillion with a TN hidden off-balance sheet dollar debt wrapped up in FX swaps around the world.
Exactly. $80 trillion. The world is structurally massively short the U.S. dollar.
Because they owe dollars they don't print.
Right. Non-U.S. entities have tens of trillions of dollars in liabilities that must be serviced, rolled over, and eventually paid back in U.S. currency.
Now, what happens when the Federal Reserve aggressively raises rates and shrinks its balance sheet through quantitative tightening?
The supply of available dollars in the global system shrinks.
And the cost of servicing that $80 trillion mountain of debt skyrockets.
Yes. It triggers a global margin call. It is basically a game of musical chairs, and the chairs are U.S. dollars.
Wow.
When dollar liquidity tightens, the desperation to secure those dollars overrides everything else. It overrides local economic fundamentals, it overrides geopolitical allegiances, and it completely obliterates traditional asset correlations.
Because foreign institutions aren't bidding up the dollar because they love American economic policy.
No. They are buying dollars because if they don't, they default.
It's survival.
This creates a permanent structural bid for the dollar that acts as a black hole for global liquidity.
So we have the yield differential acting as a magnet and the euro-dollar short squeeze acting as a vacuum. That brings us to driver number 3.
Direct, heavy-handed central bank intervention.
Right. We have transitioned into a regime where central banks are no longer just referees setting the overnight rate.
They are active, aggressive participants on the field, actively distorting the pricing of risk.
Yield curve control in Japan is the obvious example we already covered, but we see this everywhere now, don't we?
We do. Look at the ECB's Transmission Protection Instrument, or the TPI.
What exactly is that?
It is essentially a mechanism for the European Central Bank to selectively buy the bonds of weaker European nations, like Italy.
To prevent their yields from spiking too high relative to German bonds.
Exactly. In a true free market, if Italy runs massive deficits and growth stalls, investors sell Italian debt, yields spike, and the market essentially forces austerity.
The market imposes discipline.
Right. But the ECB steps in and absorbs that risk to keep the Eurozone intact.
They socialize the sovereign risk.
Exactly. But, and this is key, when a central bank distorts a natural market force in one place, the pressure has to vent somewhere else.
Like squeezing a balloon.
Yes. You cannot destroy energy in a financial system. You can only redirect it. If you artificially suppress sovereign bond yields, the volatility simply transfers to the currency markets or it manifests as inflation.
You cannot analyze historical correlations by assuming free market dynamics when the largest actors in the market have unlimited balance sheets and are actively mutating the capital allocation process.
That is exactly right.
Which perfectly sets up driver number 4, the reality of overlapping forces. I mean, the old map was built on the assumption that only one dominant narrative mattered at a time. Either growth was accelerating or it was decelerating.
A simple binary.
Right. But today, we are dealing with a historic collision of macroeconomic vectors all at once. We have sticky structural inflation driven by deglobalization and demographics.
Right.
We have massive fiscal dominance, where government deficit spending is so large, it blunts the impact of monetary tightening.
We do.
And we have extreme geopolitical fragmentation, leading to supply chain reshoring. It's less like a simple tug of war and more like, I don't know, complex fluid dynamics.
Fluid dynamics is a great way to think about it.
Think of a massive multi-chamber dam system. In the past, maybe one floodgate opened at a time. Now the inflation floodgate is open, the fiscal deficit floodgate is fully open, the geopolitical shock floodgate is open.
And the central banks are desperately trying to pump water back upstream.
Exactly. The water is forced to find the path of least resistance based on violently shifting competing pressures.
And traditional correlations are just the old watermarks on the wall from a time when the river flowed predictably.
Wow, yeah.
When these new forces conflict, and they conflict constantly today, historical patterns simply shatter.
Okay, so if I'm an institutional trader or, a corporate treasurer trying to hedge currency exposure, how do I actually survive this?
That's the million-dollar question.
If all these overlapping macro forces are colliding, how does the market reconcile them? What is the core physics of these competing forces on a day-to-day basis?
This brings us to the fundamental axiom of the new regime. It is the most vital concept to internalize right now.
Lay it on me.
Markets do not respond to narratives. They respond to the dominant mechanical force in the system.
And math beats the story.
Always.
But Wall Street runs on stories. I mean,
Right.
human beings love a good narrative.
Humans are narrative-driven creatures, absolutely. We love simple heuristics. War is breaking out, so safety is paramount. Or inflation is peaking, so long-duration tech stocks will rally.
Right, it's easy to digest.
But when multiple conflicting forces are present at the intersection, the structurally strongest force, the liquidity and the yield, will always dictate the outcome, regardless of the media narrative.
Let's walk through a specific day-by-day scenario of how the math steamrolls the story in real time. Give me a concrete example.
Okay, let's look at a classic geopolitical shock combined with an inflation print. Imagine news breaks over the weekend of a major escalation in the Middle East that threatens the Strait of Hormuz.
Huge oil choke point.
Exactly. The immediate narrative on Monday morning is pure fear. The story tells you to buy gold, buy treasuries, sell equities.
And initially, the algorithms might execute that exact trade based on headline scraping, right?
Yes, they scrape the words escalation in Hormuz and buy gold. But let's look at the fluid dynamics.
Okay.
That specific geopolitical escalation immediately causes crude oil prices to spike, say, 10%.
Right.
By Tuesday, the bond market realizes that a 10% sustained spike in oil is going to bleed directly into headline CPI.
Inflation expectations instantly re-anchor higher.
Exactly. And if inflation expectations rise, the Federal Reserve cannot cut interest rates as the market hoped. In fact, they might have to signal further tightening.
Which means nominal bond yields aggressively push upward.
Yes. Now look at the competing forces on Thursday. The geopolitical story is pulling gold up.
Because of the fear.
But the resulting inflation shock is driving bond yields higher, and those rising real yields are mechanically pushing gold down.
You know what happens?
The structural pressure of the yield completely overwhelms the sentiment pressure of the fear.
Always.
Always. The yield differential dictates the capital flow. The trader who traded the story of fear bought gold on Monday and got stopped out by Thursday.
Oh, man.
The trader who traded the force of rising real yields shorted gold and profited. The dominant mechanical force determines the outcome, period.
So if you're just trading the headline, you are the liquidity for the institutional players who are trading the actual plumbing.
You are the exit liquidity, yes.
But this raises a massive psychological question for me.
Yeah.
If the math is so clear, I mean, if the breakdown of these correlations is obvious when you analyze the yields in the Eurodollar system, why do brilliant, seasoned professionals keep getting it wrong?
It's a great question.
These are people with armies of quants and unlimited data access.
Yeah.
Why did so many macro funds blow up assuming bonds would hedge their equity books in 2022?
Because we are moving away from pure mathematics and entering the realm of institutional psychology and structural constraints.
The human element.
And institutional psychology is fiercely, stubbornly resistant to regime change.
You're talking about the psychological trap of anchoring bias.
If we connect this to the bigger picture, it goes much deeper than just a cognitive quirk. There is a deeply ingrained reason why professionals rely on outdated correlations.
What is it?
Their entire risk management infrastructure is built on them.
Oh, right. The models themselves.
The human mind seeks patterns, yes, but more importantly, institutional value at risk models, VAR models, require historical data to calculate risk parameters.
So it's not just that a portfolio manager wants to believe stocks and bonds are negatively correlated.
No.
It's that the compliance department software assumes they are negatively correlated based on a 20-year look-back window.
Exactly. If you have 20 years of data showing that when equities drop 5%, bonds rally 2%, your risk models will literally spit out a report saying a 60-40 portfolio is incredibly safe.
Because the computer only knows the past.
Right. The manager anchors their expectations to the behavior seen in the 2008 financial crisis or the 2020 pandemic shock. They build massive amounts of leverage, assuming that protective correlation will hold.
But isn't it completely natural to trust something that worked perfectly for your entire career? I mean, if you've been trading since 2005, a deflationary central bank cushioned environment is literally the only reality you have ever known.
The only reality.
How do you just turn off that mental programming when the underlying physics change?
It is agonizingly difficult. And this is where cognitive dissonance destroys capital.
Explain that.
Because when reality diverges from the old map, When both equities and bonds sell off violently together, as they did in 2022, they don't instantly realize the macroeconomic regime has fundamentally altered.
Right, they can't see the forest for the trees.
Instead, they rationalize the price action.
They treat it as a temporary anomaly.
They say things like, the market is just acting irrationally right now. It's a temporary dislocation driven by poor liquidity. The historical correlation will snap back. I just need to average down and hold on.
They blame the market for being wrong, rather than admitting their foundational framework is structurally broken.
It's the classic trap.
I'm not wrong, I'm just early.
Precisely. But markets do not care about your rationalizations. Markets ruthlessly punish ideological rigidity.
So true.
The longer a manager clings to a broken correlation, hoping the central bank will step in to save them, the more exponential their losses become.
Wow.
In a regime change, anchoring bias is a terminal disease for a portfolio.
So we've diagnosed the onus.
Yeah.
We know the old correlations are dead because the great moderation is dead. We know the real driver's rate differentials, dollar liquidity, fiscal dominance.
Yes.
And we know our own institutional risk models are actively lying to us based on outdated data. How do we rebuild the map? What is the actual solution here?
We have to discard the flat two-dimensional map entirely.
The asset A goes up, so asset B goes down map.
Exactly. Throw it out. We have to replace it with a dynamic, three-dimensional mental model that separates cause from effect.
Okay, I like where this is going.
We need to understand correlations not as permanent laws of finance, but as temporary conditional outcomes of specific underlying forces.
A three-dimensional model. Walk me through the architecture of that.
Think of the market in three distinct sequential layers.
Okay.
Layer 1, the deepest foundational bedrock, is the regime.
Define the regime in this context.
The regime is the macroeconomic weather system. It is defined by the dominant secular forces we discussed earlier.
The structural stuff.
Right. You must ask, what is the primary gravity of the market right now? Are we in a disinflationary ZIRP regime?
Like we were in the 2010s.
Right. Or are we in an era of fiscal dominance, where government spending overrides central bank tightening? Are we in a structurally inflationary regime driven by demographics and deglobalization?
You have to figure out what game you're playing.
You cannot make a single asset allocation decision until you explicitly define the regime, because the regime dictates the rules of the game.
Okay, so layer 1 is the regime. Once I've identified that we are, say, in a fiscal dominance regime with sticky inflation, what is layer 2?
Layer 2 is the structure.
The structure, meaning what?
This is how the global financial architecture is physically positioned around those macroeconomic forces.
Like the actual plumbing.
Yes. Who
Yeah.
owns the debt? How are the massive carry trades positioned right now? Is the U.S. Treasury funding its deficit by issuing 30-year bonds, or are they flooding the market with short-term T-bills?
Which completely alters the supply dynamics at the front of the yield curve.
Exactly. The structure is the plumbing. It dictates how capital is allowed to flow when the regime applies pressure.
So if the regime is the volume of water entering the dam system, the structure is the exact layout of the pipes, the valves, and the regulatory blockages.
That is exactly right. If the plumbing is clogged with 80 trillion in eurodollar swaps, the water will behave very differently than if the system is flush with liquidity.
That makes perfect sense.
And that analysis leads us directly to layer 3, which is the outcome.
The outcome is the actual price action on the screen. Right?
Yes. The outcome is the daily, weekly, monthly price movement.
Why?
And crucially, this is where correlations actually live.
Wait, so correlations aren't the foundation at all. They are the absolute last step in the chain.
This is the breakthrough insight that separates the survivors from the casualties. Correlations exist only at the outcome layer.
They're the exhaust fumes.
They are the final, trailing byproduct of the regime filtering through the structure.
Wow.
When the regime changes, when we move from zero interest rates to sticky 3% inflation, the structure aggressively adjusts, and the historical outcome completely inverts.
Therefore, treating a correlation as a stable, permanent law without constantly reevaluating the underlying regime is mathematically backwards.
It's absurd. You are trading the symptom instead of the cause.
So if I'm a macro analyst looking at this new three-layer model, my daily diagnostic process completely flips. I don't look at the VIX and assume Treasury bonds will rally.
Completely flips. You shift your focus entirely from the assets to the drivers.
Right.
You stop asking, what should gold do today? based on a 20-year backtest.
Because gold doesn't do anything in a vacuum.
Exactly. Instead, you ask, what is the U.S. Treasury's issuance schedule doing to real yields at the long end of the curve?
Because the yield issuance is the structural driver.
Exactly. You stop assuming the yen will strengthen if the Nasdaq drops.
You analyze the plumbing instead.
Yes. You ask, what is the Bank of Japan's threshold for inflation before they are forced to abandon yield curve control? And how wide will the interest rate differential remain until they do?
You have to go to the source code.
Before executing any macro trade, the critical question is no longer what is the historical correlation. It is what structural force is currently dominating the system.
If I synthesize everything we've just unpacked, it means that cognitive adaptability is the only genuine edge left in the market.
It is the ultimate alpha.
The moment you use the word always, the moment you think treasuries always hedge equities or the dollar always weakens when the Fed cuts, you've already lost.
You're dead in the water.
You've anchored your capital to a ghost.
The era of always is definitively over. The time when it was safe and even profitable to rely on simple conditional heuristics has passed.
A new world.
We are deeply entrenched in an era defined by yield dominance, violent policy divergence among sovereign actors, and an unshakable structural demand for dollar liquidity.
And in this specific environment, relying on traditional correlations is actively dangerous.
It is practically fiduciary malpractice to treat them as constants.
You're navigating a highly kinetic, modern battlefield using a map drawn in 1998.
Precisely. And the ultimate lesson here isn't that history has no value or that data is useless.
What is the lesson then?
The lesson is that correlations are strictly conditional artifacts. They are temporary footprints left behind by a specific macroeconomic regime. And as we have seen with violent clarity over the last few years, regimes change.
The ground shifts beneath your feet. The gravity reverses.
And those who can ruthlessly update their framework as the underlying conditions evolve, those who focus obsessively on the drivers, the plumbing, and the yields, rather than just the surface-level assets.
They are the ones who survive.
They're the ones who will capture the extraordinary generational opportunities created by these massive dislocations.
Because everyone else is looking the wrong way.
Because when the herd is desperately trying to trade the ghost of the old map, they leave behind massive structural inefficiencies for those who actually understand the new math.
This has been a phenomenal breakdown. We started by talking about the disorientation of traditional safe havens failing, and we've traced that all the way down to the bedrock of global liquidity and real yields.
It's all connected.
The old rules are gone. Yield is the new gravity. The dollar is the structural anchor. The correlations we trusted for decades are just shadows on the wall.
It requires a profound, ongoing rewiring of how we perceive both risk and value.
It really does. And I want to leave you, the listener, with a final thought to take with you today.
It's an important one.
We've spent this entire deep dive dissecting how the brightest institutional minds in global finance people managing hundreds of billions of dollars are getting caught completely off guard. Why?
Because they anchor to the past?
Exactly. Because they blindly trusted old rules of thumb that silently expired. They anchored their survival to a reality that simply no longer exists.
It's a fatal flaw.
So take a step back and apply that framework to your own life. Think about your career trajectory, your business strategy, or even your core assumptions about how your specific industry functions.
What are your correlations?
Right. What fundamental truths are you anchoring to right now simply because they work perfectly for the last 10 or 20 years? What silent assumptions are guiding your biggest decisions, just as the underlying economic or technological regime is shifting violently beneath your feet?
That's the real question.
The map is not the territory. Make sure you aren't navigating tomorrow's reality with yesterday's compass. Keep questioning the underlying forces. Keep analyzing the structure.